Hey everybody, it's Matt Smith, and this is part one in a series of videos that talks about why people may need financial planning services, what that may look like. Oftentimes, I will talk to people that have never worked with a financial planner before, and they generally feel like their situation is fairly simple. They may not need ongoing help. It's pretty straightforward, and I find that that's not the case. The first thing I need to say is that my firm focuses on a specific niche of clients, and those clients are big law attorneys, associates, and partners. And so everything I'm about to say here is really in reference to this particular demographic and set of clients. And in particular, these people have significantly high incomes and taxes. So this is the current Big Law salary scale, the Cravath scale. Goes by a couple different names, a few different names. And this is published on the BigLawInvestor.com, www.biglawinvestor.com. And the reason I want to bring this up and show it to you is because I just want to highlight that although there are a significant portion of the population can probably get by doing their own financial planning work, their own investment work, all that kind of stuff. Their situations truly are not that terribly complex. That's just really not the case for big law attorneys. And two of the big reasons why are first, your income. If we just look at the salary and we don't include the bonus numbers to get to the total comp, just looking at the salary numbers, first year through fourth year associates are the top 10% of income earners in the United States. And this is right out of the gate, out of law school as a first year associate. So typically, not always, this is people in their late 20s starting out their career in the top 10% of income earners in the United States. By the time you're a fifth year associate on this scale, just the salary only, you're in the top 5% of income earners. And if you're curious about this, this is the source of this was the Economic Policy Institute research done with data from 2020. So right off the bat, just starting out as an associate straight out of law school, you're a top 10% income earner in the United States. That's based strictly on the salary number, and that doesn't factor in any spousal income or secondary income to the house. So I'm being purposely conservative here and using these figures. But regardless, if you're an associate, if you're a partner, you're one of the top income earners in the United States. You're not average. And then I'm sure you're very familiar with taxes. There's a lot going on over here. But on the left-hand side, I'm showing the marginal tax rate for a couple that files jointly, married filing jointly. So you start off, if you're a first-year associate and you are married, dual-income household, or you're just married and you file jointly, whether the second person has income or not, you're starting off in the 24% marginal tax bracket. So for every new dollar that enters your household, 24% of his tax, nearly a quarter of it, is lost to taxes. By the time you're a 6-year associate as a married filing jointly tax filer, you're at the 32% marginal tax bracket. What I find more often is that usually early year associates are single. And when you're filing single and earning $215,000, you start in the 32% bracket for your first and second year. And then by your third year, you're in the 35% tax bracket going forward. Often what happens is somebody starts in the single tax bracket and then life evolves, you get married, and you jump over into the married filing jointly tax brackets. But nonetheless, the point I'm trying to make is that your relatively high federal income tax levels. This doesn't include state income taxes. It doesn't include FICA, which is Social Security and Medicare. It doesn't include local taxes. So for those of you in New York, California, Chicago, this is the starting point, and then taxes get added on from other jurisdictions and for other types of taxes. So you'll read a lot and you'll hear a lot about how the average person doesn't need ongoing financial advice and or investment management. And I'm just here to tell you that I work with about 30 households on an ongoing basis right now. Most of them have at least one big law attorney in the household. And I'm here to tell you that your situation is not average. And I think these 2 points really highlight that. All right, so the next thing I want to do is build out kind of a chart about how financial planning needs can evolve over time, and you can kind of put yourself where you are on this chart. Now, if you thought the last one was busy, this is going to get really busy, and I apologize for that, but frankly, there's a lot going on. So what I want to talk about are areas of financial planning. So debts, resilience, that's the coolest word I can think of to talk about. Like, all of this is boring and nerdy, but like this is super boring and nerdy, which would be things like an emergency fund, lines of credit to supplement your emergency fund, insurances, estate documents. And when you hear estate, don't think about Scrooge McDuck with millions of gold coins in the bank. Think about having medical documents in place to let people know what your wishes are if you were to become incapacitated, for example. It's a lot more than just having a will for a bunch of money. Income issues, tax issues, investing issues, goals. So when we build out the framework, what I'm doing is I'm starting at age 26. Let's say that you graduated undergrad, you went straight into law school, and now you're 26 years old after 3 years of law school. And I typically run financial planning scenarios out to age 100. Obviously, there's a lot that's going to go on and change in these 74 years, and I don't want to give the impression that I think we're going to predict what's going to happen 50 years, 60, 70 years from now. But nonetheless, I run the plans out just so we can get a sense of how things will evolve over time. So first, I want to talk about income. So on the BigLaw salary scale, you have these initial associate years where you get these steady increases in income, assuming you move up in your class. And then there comes this pivot point where you decide whether you're going to go the partnership route, whether you're going to go in-house. Maybe you've made that decision back here. Maybe you're going to go senior counsel part-time. There's a million different options. For the sake of illustration, I'm just drawing as if you go the partnership track and income continues to increase until around age 63. This is just the halfway point between age 26 and 100, and it's a dotted line. We're not sure where your income is going to go. Is it going to go to zero? Might you take a step back but do a semi-retirement for a while? We don't really know. Income then determines your taxes. So you have your income amount, then your taxes are going to correspond to your income amount. And you can see, these are not always to scale. These lines are definitely not to scale, but conceptually, your income is going to determine your tax rate. And that's something that needs to be planned for and mitigated as best as possible. If, in our hypothetical, you were to stop working at age 63, you might expect your taxes to drop. We don't know exactly where, but you're no longer, let's say you're no longer a BigLaw partner attorney at this point. However, by your mid-70s, taxes typically under current law will pick up again because you're forced to take distributions from your pre-tax accounts, whether that's your 401k or a rollover IRA or something like that. If you have dollars in pre-tax accounts where you got tax deductions for making contributions during these working years, well, the IRS wants their money, and that money is going to come due starting at age 75, and that can really generate significant taxes as these funds are forced to be distributed whether you need them or not. Debts. This is a big one that virtually everybody I work with has an issue and a planning question around how to manage the debts they've incurred. Most of the people I work with have student loans. A lot of them have student loan balances that are roughly the same as a first-year associate salary, around $200,000, give or take. And so if you're going to pay those off on the standard 10-year schedule, I just show that those loans might decline from age 26 to 36. Most BigLaw attorneys are not going to qualify for income-driven repayment, and that includes the most recent income-driven repayment plan announced by the Biden administration. And so you have this debt burden that needs to be considered and worked out and balanced with your other long-term goals. And then most of the people I work with have a goal of buying a house at some point or owning real estate at some point. And so maybe you need to start thinking about having mortgage debt for like a 30-year term. And so I hypothetically show this going from roughly age 33 to age 63. Resilience, I referenced this earlier. So, you're going to have to spend some money making your financial life resilient. You're going to have to stow away some cash in an emergency cash reserve, and it's going to be important to make that as efficient as possible, make it work for you as much as possible. You're going to need to supplement the insurance that you get through work for disability, and you're probably going to need to supplement the insurance you get through work for life coverage. And then as you grow older, the need for these items may decline. So maybe sometime in your 60s, the need for disability insurance may go away because you stopped working, or you don't need to continue working. You don't need to supplement that income if you can no longer work. Maybe your cash reserve changes because your life has changed in terms of children leaving the house or whatever it may be, your spending habits, so on and so forth. And so the types of resilience and sort of strategies that you would use are going to change over time. And of course, by the end of your life, it's going to be a focus on estate planning and tax mitigation as it relates to estate planning. But nonetheless, we need to make sure that your financial life is resilient, because if it is not, then you really could face disaster in the event of tragedy or mishap or whatever comes your way. Goals. You got things you want to do. You're not doing all this work. Most of you are not doing all the work you're doing just because you love to work, 2,100 billable hours a year, or 2,200 or 2,300 or whatever it is at your particular firm. Most of you are doing the work that you're doing because you have things that you want to achieve. And it may be paying off the student loans. It may be buying the house. It may be having the high income. It may be traveling. It may be raising a family. It could be a million different things, but you have goals. And those goals largely are, not largely, those goals are funded by your income and what's left over after you've dealt with the taxes and with the debts and with making your plan resilient. And those goals evolve over time. So once again, this is not to scale, but the idea here is just to show that the goal, the cash available for goals is going to change over time and generally increase as your income increases. Finally, the investments. This, I have to be absolutely clear that this is in no way designed to imply any promise of investment returns. I think you know that, but I need to say it out loud. When you're starting, most people that I work with don't have much to invest. They're young attorneys. They're paying off student loans. They are buying houses. They're having families. They're living their lives. You don't have a huge investment account from which to bill, and therefore you may not qualify for some of the larger banks that have investment minimums and things like that. But your investments should grow over time. I believe that they will grow over time. And their ability to grow over time has a lot to do with your income and your ability to save. And that's something that we need to plan for and map out. We need to balance it with paying off your debts and with paying taxes, funding goals, and making sure your plan's resilient. And over time, ideally, your investments increase. And then at some point, your investments take over. Now, at some stage here, after your working years, it's no longer about your income. Your income is a derivative of your investments. And so in this area, your income is the primary focus that drives the rest of your financial plan strategies and abilities. And at some point that converts over to where your investment accounts are going to be the primary drivers of the other things that happen in your plan. So overall, the way that you might think about this is you might have an accumulation period of about 30 years. I say 30 years-ish. And during that time, we're going to be focusing on debts, taxes, your income, and investing. So I used to always say we want to manage your debts, we want to minimize taxes, we want to optimize your income, and we want to do the best we can with investments. Frankly, the term that I used is failing me because I've removed it. But these are the four things that we typically want to focus on at a high level. At some point, you're going to enter a transition phase. I don't know exactly when that is, but at some point you may decide to take a sabbatical, go into semi-retirement, open a business, do something different. And then eventually, during this transition phase, you'll transition into a full retirement. And finally, speaking in generalities, you may have a distribution phase where you're living off of your savings and investments for, let's call it 30 years, approximately age 70 to age 100. You might have sub-phases, just like over here, where you have an active period of retirement, you have a transition period of retirement, and then, at a certain point as you age, the issues really become longevity. You're likely not traveling the world, but instead you're facing longevity issues at home. So, when we look at this, oftentimes what we think about is financial planning, investment management, all that stuff is reserved for rich retirees. The reality is that is how the industry is set up. That is not necessarily what I am focused on in my practice. You can see that there is a lot going on during these accumulation years. You have a lot of moving parts, a lot of disparate issues, where moving a lever in one place is going to cause a domino effect to cause changes in other aspects of your financial plan. And so one could argue that it actually becomes more straightforward, certainly a very different set of topic areas when you get into the retirement stage. And the underserved community when it comes to financial planning services are those of you that do not have large investment accounts yet from which to bill fees, but you definitely have complex issues and you definitely have the income to afford an ongoing relationship, and you can definitely afford to delegate the day-to-day work and delegate to an expert to help you make the best decisions you can as it relates to juggling all of these different things. Big law attorneys have very little time on their hands. Frankly, usually you have negative time on your hands. And although you have the capacity, the brain capacity to become an expert in this stuff, you're probably not an expert in this stuff. And the people I work with understand that they're not the experts. They don't want to learn to be the experts, and they're not interested in doing it on their own. They're interested in hiring an expert who can help them through the process and manage all these different things as their life evolves. And let me tell you, it definitely evolves and things do change, and it is ideal to be working with somebody who understands your situation, and you're not having to go back to new people each time who have to hop on a moving train to get reacquainted with your situation. So that's part one of the kind of the financial planning needs and evolution. The next thing I'm going to show you is how we go about addressing these various topic areas with you and give you a sense of where we can help you save money, where we're not totally sure, and maybe in an introductory phone call we can determine that, and then areas where, frankly, we may not be that much of help to you. And that is called the primer plan. It is a one-page high-level overview of how we can apply different strategies in each of these topic areas and deliver serious value to you. So please stick around for that. Thanks.